Hi, we'll start in just a moment. All right, so the meeting is being recorded, so you'll be able to watch it back on my YouTube channel. Remember to subscribe there because I am planning on doing these video conferences twice a month. So it's just youtube.com/Natalie Pace 2. Today is April 30th, 2020, and it's hard to even imagine 2019. It feels like such a different world. I know we're all feeling this way. My life isn't changed that much because I've had a Wi-Fi paperless telecommute office since 2002. And I'm feeling stir crazy. So I can't imagine those people that went to the office every day, how you must be feeling. So first and foremost, our hearts and our prayers are with anybody who's suffering right now, anybody that has had to overcome this microscopic beast that has taken over our lives, and also any of us that are feeling, the pressures of it. I'm going to ask everybody to please keep themselves muted so that we can have a nice, clean recording. All right. I'm going to start off. Again, it's April 30th, 2020. We're in the middle of a coronavirus pandemic. Hopefully, this will be something that in a few months we will be on the other side of or starting to exit out of. However, there's a lot of things going on right now that I think are really important for us all to be aware of, to know, to be factoring in. The thing I should tell you is that a lot of people are relying upon articles or the news or politicians for their information. Data is the best source of information. And the reason for that is that data tells us what's happening. The headlines tell us, and stories and all of that tell us what happened. If you wait for something to happen, it's really hard to prepare for it. If you can see what's happening, then you can prepare for it. So then the third thing is the politicians tell us who's to blame after we learn what happened. So that's the last thing, is that you're going to have the politicians admitting we're seeing that is already happening. Again, by the time it hits the headlines, it's too late for you. So it's really good to be aware of the data. And in that department, I think a picture is worth 1,000 words. And so I am going to be sharing the screen and talking a little bit about data while showing you the pictures of some of the data sources. So the first one is this. I think it's important for you to see what unemployment looks like these days. This is the chart. So again, they've only been keeping this kind of data since, pre-1970. So it's not going back to the Great Depression, although people are saying this is unprecedented and may even be worse than the Great Depression was. So as you can see, we went along for decades and decades and decades, actually for over half a century, with pretty low unemployment, low jobless claims, and then this line that you can barely even see that reaches to the sky on the far right side, that's what the jobless claims look like now. So we had unemployment of at least 12 million people, and that is 12.4%. It's higher than that because that's from last week's numbers. So other data that you need to be knowing. The Dow futures are down. They were down as low as 301 the last time I checked. Our first quarter GDP was minus 4.8%. So let me show you what that looks like. Hold on. And again, a lot of this data is in my blog. So if you just go to nataliepace.com/blog, this is the first blog that will come up. So the recession will be announced on July 30th. I'll tell you why it will be announced then and not now in just a moment, but take a look at some of these pictures. So we just had first quarter GDP reported, and it was a contraction of 4.8%. Second quarter GDP is expected to be lower than that number by another 12% contraction. And on the year, it would be a 40% contraction. This is obviously estimates. We don't know exactly what it is yet because we're still in the thick of it. The second quarter ends at the end of June, and then we get the advance report on the second quarter July 30th. And that is why we will not get the headline that we are in a recession until July 30th, when the second quarter of contraction is announced. Now, here's another chart that I want you to look at. So this is an updated chart, but I actually have one from January of 2020, before the pandemic crisis. And the reason I think it's important for you to see both of them is because before the crisis, a lot of the problems that were already evident. So we had asset bubbles before the crisis. And this is something that was making everything iffy. So unemployment was low, and the stocks were high. And so politicians will say, hey, unemployment is low and stocks are high, so you're richer, everything's great, real estate's high, everything's great. But what they weren't saying is that stocks had been overpriced. So in other words, the only two other times when stock prices were in that much of a bubble was before 2000. That's the dot-com recession, where the NASDAQ lost 78%, and 1929, which was the Great Depression. So we already knew that stocks were in a bubble in January of 2020. And then the high was February 19th of 2020. And since then, we've seen a contraction of about 17. We've seen it up to minus 35% losses. We're now at about 18% losses. And again, with us being in a recession that hasn't been announced, so most people don't know we're in a recession at this point, are still hoping for the best, there is predicted to be weakness in stocks, also in real estate. So you can see here that home prices were higher than ever as well. So the average home price here was a high back in June of 2007. It's now much higher. And again, when you have at least 67% of the cities in the United States unaffordable to the people who live there, that's a real problem. Here we have public debt was 23 trillion. If you look at consumer debt, higher than the Great Recession. Corporate debt has gone absolutely astronomical, as has public debt. So all of these troubling indicators of asset bubbles were from January, before we got into this trouble that we're in. And now, of course, you combine all of those asset bubbles with a recession and astronomically high unemployment, you have a real problem. So this is Robert Shiller's graph that shows you just how high stock prices are and how high they got. So here it is. That's how high they were. They're still far too high historically. So the average PE is about 16, and they're still 26 range. So they're still too expensive. So I do encourage you to take a look at this blog. And then here is the map of unaffordability in the United States. So as you can see, there's a lot of red and orange. If you live in Colorado or in California or Washington, Oregon area, or even Florida, where you think things could be more affordable, it's still unaffordable to the people who live there. So again, when you have asset bubbles in a recession, you tend to have things that move much more quickly on the downside. So some of the other data I wanted to give you is that a lot of corporations have had to suspend their buybacks. I'm going to stop the screen share, so hang on just one second, and I'll go back to, you can see me. All right, so a lot of companies, especially those that are taking either loans or bailouts, are suspending their buybacks, and many of them are going to have to suspend their dividends if they haven't already. Now, Apple increased its dividend and it's on track to do the same buyback program. Having said that, the last time it still lost a lot of money, even though the buybacks have been as strong as they were last year. So Apple is the top of all the companies that are buying back their own stock, and Bank of America was number 2. Apple was number 1 with $80 billion every year being done in buybacks. It was actually $81 billion last year. So they're going to continue doing that. But their sales were pretty weak. The next quarter is expected to be weaker. And their income wasn't so good either. So I think it's important because they've canceled their guidance for the second quarter. They've said that their iPhone sales are going to be down, and iPhone sales does account for about 61% of their sales. Their Mac and their iPod sales are going to be slightly up, but that's only 14% of their revenue. So the long and the short of it is that prices are too high in whether it's real estate, stocks, or bonds. And bonds are over leveraged and illiquid. And I'm going to tell you a couple of stories about that. Leverage is too high. So over half of corporations were borrowing and borrowing and borrowing, and not like Apple borrowing to pay dividends. And Apple still has a warlord of cash. A lot of companies didn't. And, they're in the trouble like Ford is, where they're one rung above speculative or junk bond status and in danger of being downgraded now. And also money market funds and CDs. So before we had any stay-at-home orders, the Federal Reserve had to bail out money market funds, the capital markets, and banks. So that should tell you something. Now, also money market funds are the way that the banks are going to do a bail-in plan on your dime. They don't have to get a bailout next time because they have added a clause in 2017 to money market funds that is redemption gates and liquidity fees. And what that essentially means that if they get into trouble, then they may say you can't have your money right now, or they may charge you a fee to have access to your money. Also CDs, sometimes they're paying you, 0.5% or 1%. And if you need the money before then, the penalty is going to be much higher than what you're receiving on it. And if they're high yield, they could lose money and they may not be FDIC insured. And high yield could be 2% or 3%. So I think what's really important today is to make sure that you are acting your age. And what that means is that you should be keeping a percent equal to your age safe. We're actually overweighting 20% safe. It's your choice whether or not you want to do that. But let's say, for instance, that you are 50 and you're overweighting 20% safe. That means that you have 30% at risk. If the markets go down by half, which they did in the last 2 recessions, then your exposure to losses is only 15% in that scenario. And the 85% is going to be in good shape. That puts you in a great position once the recovery begins. It also puts you in a great position because the reason that most people don't buy low is that they can't buy low. They've lost too much money and all they can do is hope to recover. If you have liquidity, then you can buy stocks low. You can buy real estate low. You could buy safe income producing hard assets that you purchase for a good price low. If you don't, if you just ride the Wall Street roller coaster, then all you can do is hope to recover. And if you're over the age of 50, that's not a good way to live. It's not a good way to live even if you're 30, honestly. So the bottom line is that you need to act your age, you need to overweight safe, and I'm suggesting up to 20% overweight safe. You need to properly diversify the at risk, and you need to know what's safe in a world where bonds are losing money, where they are illiquid, where money market funds have redemption gates and liquidity fees, where certificates of deposits may not be FDIC insured and may lose money, or may have an opportunity cost, or may cost you in penalties, and also in a world where real estate is in a bubble. So I'm going to show you a couple of pie charts that get you kind of on the right track. And then I'm going to tell you a few stories, and I'm going to answer a question that was emailed in. Remember that you can email in your questions to us. I only take a couple in these video conferences, but we're happy to answer. And sometimes you have a question where we have already answered it, and all Heather has to do is to give you a link to the article or the blog where we've already answered the question. All right, let me show you a chart. So I'm going to go back to screen share. All right, so first one I wanted to show you is this one. So this is what a sample pie chart looks like. And again, you want to act your age and then overweight safe. In this scenario, I've overweighted 20% safe. And then you're going to diversify the at-risk into 10 different funds. I say small, medium, large, value and growth, and then 4 HOTs. Now, I have been doing second opinions now for about 2 years, and I have yet to find one managed portfolio, whether it's the person managing it themselves or a managed portfolio by a professional that is properly diversified and properly safe. There's a couple of reasons for that. First off, they just mostly are putting you in large cap value. Secondly, on the safe side, the only thing they can sell you are stocks and bonds and money market funds. And if money market funds have redemption gates and liquidity fees, and bonds are over leveraged and liquid, what else can they sell you? So you're you kind of need to know what you own so that you can be the boss of your money. Because if somebody who manages your money loses it, then all you can do is hope to recover. Because what they're going to tell you is, if the stocks start to go down or bonds start to go down, they'll say, well, don't worry, it'll come back. And then when it gets so low, like again, the Great Recession, stocks lost 55%. And in the dot-com recession, dot-com stocks and NASDAQ stocks lost 78%. At that point, you are sick of it and you're ready to sell low. And they're going to tell you, don't sell now because you'll sell low. And they're right. Because at the top of the market, you should have been acting your age. You should have been overweighting safe. You should have been properly diversified. And in today's world, with so much leverage, absolutely astronomical, you have to know what's safe. So there's no solution. You have to know the ABCs of money that we all should have received in high school. And again, it is literally easy as a pie chart. Anybody that tries to make it complicated is just trying to do it for you. If you really want to know what you own, then you're going to have to get a pie chart of what you own. Consider getting a second opinion from me. The reason that I say my second opinion is unbiased is because I don't manage your money. I want you to be the boss of your money, but I can tell you what you own. And I can educate you on modern portfolio theory and annual rebalancing, which is a buy low, sell high plan on autopilot. And with that power, you can be the boss, whether you manage it yourself and self-direct it, which is easy when it is easy as a pie chart, or whether you have someone else do it for you. And either way is fine, but it's not okay to have blind faith. And it's never a good idea to have blind faith in a recession. All right, so I want to tell you a couple of stories. The first story is of D&T. And they were sold into private placement REITs. And they were told that these were safe because they would own real estate. When they called our office, my assistant thankfully told her, sorry, REITs are stocks. So you own stock in a company that owns real estate. And what that means that if that company declares bankruptcy, you no longer own the real estate because your stock becomes toilet paper. Some companies can actually continue operating and just sell stock to new shareholders. The old shareholders are out in the lurch. So it's not a good idea for you to be sold into something like this, thinking that you actually own the real estate because you don't. Also, that was very high yield. And that's what they liked because the salesman told them, hey, you're going to earn a really good income on this. Well, when they discovered that all of these companies had been cash negative for 3 years, they decided they wanted to exit all of their REITs. And that was over a year ago. And their brokers stopped returning their calls months ago. And finally, they threatened to report him to the SEC and to FINRA. He did return their call very promptly then. He was very hurt that they would suggest that that's what they needed to do. And he admitted that one of the companies had already gone bankrupt. So they had already lost 18%. They are still trying to get their money back. Here's another scenario. Another person was sold into bonds as safe. And this person was sold into a bunch of 20-year bonds. Now, the bond was paying like 3%. Do you really want to have a 3% ROI on a bond for 20 years when everything is so over leveraged and it's getting more and more dangerous that they're going to have to restructure? In Congress, there's a debate on whether or not states should be allowed to go bankrupt. That should be a big red flag for you. So this person tried to sell the bonds and there was no buyer to buy it. The trouble is, now they did sell the bonds, but they had to sell them at a loss. But the trouble is, the longer they wait, they may not be able to sell it at all. And then it becomes more and more perilous that you're going to get your money back. So as Roy Rogers famously said, I'm more concerned with the return of my money than the return on my money. Now, there was another story I wanted to tell, and that is, it was a real estate broker in Boulder. And we were talking, and she has only been a real estate broker since the recovery. She was not involved in the Great Recession. Now, she said, well, Boulder doesn't go down. Now, I looked it up, and it did go down in the Great Recession, but not as much as the other places. And the reason for that is that it didn't go up very much. So the places where the real estate bubble was the most severe, like Las Vegas, Florida, California, Arizona, and New Mexico, those saw the most implosions. The places where real estate did not go up so high, they saw a little bit of a downturn. Now, what's happening now with real estate higher than ever is those places that are most unaffordable, of which Boulder is one, to the people who live there are the ones that are going to be the most vulnerable to have the most severe losses. So even though it is true that Boulder and other areas of the country did not go down as much in the Great Recession, that doesn't mean that it's true this time when they have gone up so much and they've become unaffordable to the people who live there. Other problems with real estate are that when people start losing their jobs and they stop paying their mortgage, then you're going to have more houses that are for sale. Also, the lending standards get tighter in a recession. So you have smaller pool of buyers. And with people concerned about their job, they're going to be less apt to want to buy a new home, particularly if they're stretching at the top of their budget in order to get it because it's too expensive. So there are fundamentals that should equate to home prices being suppressed. And again, you're not going to start hearing that we're in a recession until July 30th. So the time to start realigning everything in your life, from the budget to how you are invested in stocks and also real estate, is now. Also, there's a lot more shadow inventory than people are being told. At least 3.5 million Americans before this coronavirus recession, at least 3.5 million American homeowners were severely underwater on their mortgage. So they owed 25% higher than what the value of their home was. And that's with real estate at an all-time high. So there will be a lot more in the shadow inventory. So when you're getting ready to start shopping for something, you should be thinking about the shadow inventory rather than the multiple listing services, because that's the area that's going to start ballooning a lot more than the MLS. All right, I do have a question that came in. And remember again, also, by the way, you can ask questions on social media. We'd love to get you a little bit more interactive on Instagram, Twitter, and Facebook. So you can check all of those. You can link to them on the homepage at nataliepace.com. It's Twitter, at Natalie Pace. On Instagram, I'm Natalie Wynne Pace, so my middle name is W-Y-N-N-E. And on Facebook, it's the ABCs of Money. So let me get this question in real quickly. So this question came from Jack, and he said, I know you don't like financial markets right now. Would you suggest getting rid of bank stock like Bank of America? Well, the first thing is, Jack, it's not that I don't like financial markets. I actually love stocks. That's why I do my job. But I love a good time-proven strategy. So what I like, and again, I'm going to go back to the screen, is for you to be properly diversified. So here you can see large cap value, large cap growth. Bank stocks are part of a large cap value fund. I would be underweighting them, but I would not have individual bank stocks at all. And part of the reason for that is that I would not want individual companies in my nest egg because I want money while you sleep. So I suggest a large cap value fund that might have a few banks in it so that you can still not have to worry about every single company within the fund. If it's got 100 companies in there, it's so that you don't have to worry about it. Now, in terms of financials, I think that you should be aware of the fact that the markets are down 18% right now, but Bank of America is down 32.6%. Also, the banks have suspended their buybacks through at least the second quarter of 2020. And that's part of the reason why bank stock was so high, was that they were buying back their own stock. Now, they haven't yet suspended their dividends. However, if the second quarter starts seeing problems, which it's supposed to see, then they will have a lot of conversations, lively conversations with their board about suspending the dividend as well. So the bottom line is I would be underweighting financial services within my large cap value fund, but I would not own any individual bank stocks or any individual companies in my money while you sleep. You could have individual stocks, but those are education or fun, kind of like Vegas money, not your money while you sleep, because you have to babysit individual stocks, particularly in a recession, because a lot of times earning gains in a recession outside of things that might go up if stocks go down, like maybe gold, it's like trying to catch a falling knife. You get a lot of blood on your hands. All right, I want to thank you for joining me for the video conference. Remember, if you're interested in our online retreat this weekend, you can still register. We'd love to have you. As you can see, it feels like I'm right in your living room. It's a lot more fun than you might imagine. It's much easier than you might imagine, and it is absolutely life transformational. I'm proof of it myself. I had to live my way into the answers. If I had not been aware that we were going into a recession during the dot-com recession, I would not have this career at all. So again, I was the one that was least popular in December of 1999 when I said, I think that we're headed into weakness, and everybody wanted to think that we were in a new economy and that stocks would be high forever. So be careful of just thinking that everything goes on forever, because it doesn't, particularly right now when we have exceptionally high unemployment and we are in a recession. Thanks again. So again, how can you reach out to us? info@nataliepace.com, 310-430-2397. Again, 310-430-2397. And of course, on social, we'd love to see you there as well. And for those of you that are volunteers, I'm going to do a stock masterclass on May 9th. So be sure to email Heather, info@nataliepace.com, if you might be interested in that as well. All right, thanks again for joining me. Email in your questions. We may already have the answers in a blog, and I'd love to see you. Thanks.